Now it's time to talk about the most important thing for you to become a successful trader, the risk management. As I've told you before, less than 10% of importance goes to technical analysis when it comes to become a successful trader. The other 90% is only about your psychology and how would you react as a human being with emotions within this risky and volatile markets. And then by having a proper risk management and money management system, you're going to be successful. Because already we have accepted the fact that we stepped in a stressful and risky market. But how do you become a successful trader? Don't go anywhere. Stick to this video until the end because each and every second worth like millions of dollars. Why? Because these are my own experience throughout years. Believe me, your trading strategy, I don't want to say is not important. Of course it's important. And you must have a proper one, or let's say proper ones for different types of the market, which I taught previously in previous seasons. If you haven't checked those videos, go check them out. But there are lots of trading strategies which really work. I don't want to say it's really easy to make money in financial markets, but if you want to divide the things that we have to do to become a successful trader, the easiest part of it is how to gain money. The hard part is how to maintain it and then how to grow it through time. And the secret to do that properly is coming up with a good and reliable and let's say less risky money management and risk management system. If you're new to trading, I highly recommend to go and start my videos from the scratch, which I'm going to leave a link above here. And both down in the description, and start from the scratch from the episode 1, season 1, let's say module 1. And because these are the chains of study and chains of lessons, which you have to watch them right after each other, and then come watch this video. If you haven't watched those, this video is not for you. But if you're already into trading and you've been there for a while and you're here to know only about risk management system, okay, then just to start right away. Trading is not a get-rich-quick scheme. It's a marathon. One of the most important skills you need to master as a trader is risk management. Now, let's go for some key concepts of risk management in trading, including stop loss, take profit, and leverage. When you enter a trade, you're essentially making a prediction about where the market is headed. But even the most experienced traders can't predict the future. That's why risk management is so important. Stop loss is an order that you place to automatically exit a trade when the price of an asset reaches a certain level. It's a way to limit your losses and protect your capital. When you set a stop loss, you're essentially saying if the market goes against me by X amount, I want to get out of this trade. Stop loss orders are particularly important because they help to reduce losses on trades that have gone against you. They can be set at a specific price level or percentage of the trade size, depending on your preference. Stop losses can be adjusted during a trade, but it is important to remember that they should never be moved further away from the entry price, as this increases the potential loss. So if you don't know how to work with a TradingView platform, I've made previously a full dedicated video about this. And if you haven't watched my last season, the season 2 of how to become a trader, cryptocurrency, you have to watch that. It doesn't matter if you want to trade cryptocurrencies, stocks, commodities, FOREX, it doesn't matter. It's for all of you. You must be familiar especially if you're new to trading, you must be familiar with the concepts of support resistance, candlestick reading, or let's say candlestick chart patterns, even chart patterns themselves, and trading indicators, at least the basic ones, because we're going to talk a lot about them. How can you find the stop loss and take profit? Where is it on the chart? Well, you have to find first the long and short positions tools. It's just right here. You can make them favorite and they're going to pop up here in your favorite toolkit. Let me zoom in. So I'm going to just simply draw my support level here. Let's change the color to green, and then I'm going to set my resistance level above here and change the color to red. Just easy peasy like that. Let's see if I wanted to enter a trade. Let me bring my indicator on the chart. I'm going to use RSI and 20 period EMA. And beautifully, so I waited for the price to reach this support level. How to draw them, how to draw support and resistance levels, I'm going to leave the link both down in the description and above here during the video. So you must watch those videos too if you haven't. And if you don't know what I'm talking about at all. We had a beautiful divergence here in the price. So a lower low in the price. Let me change the color and make it more visible to your eyes. Yeah. And then we had one higher low in the price in RSI. Just like that. And I wait for the price. You can see the indications, which is telling us that the price tends to go up. Okay, 3 white soldiers, beautiful. But I wait for a strong candle. By a strong candle again, I mentioned this previously, but I'm going to mention it here quickly again. A strong candle means a candle with a healthy body, not a doji like this here. So I'm going to enter a long trade here. And this is the part which I'm going to talk about. The stop loss, take profit, and different types of this tool. Let me remove candles for a moment and even the indicators, just like that. Yeah. So let's get familiar with different parts of it. The first part is your entry point, which you're going to enter a trade due to your strategy, your plan, whatever it is. And then we call it this entry point. This is our entry point. Let me write it down for you. Entry. We have take profit, which is going to be this green or blue. You can change the colors, everything in the setting. So it's all here. I've talked about those previously. But so this is going to be our TP and or take profit and or target point. You can call that all of those. So this is, and then we have the most important thing here, the stop loss. So I'm going to write it down in red. SL and or stop loss. The name can show us crystal clear that it's me stopping your losses, just like this. The entry point, and in a long trade, let me write it down too. Long position, long or say buy. In a long position like this, the stop loss is always going to be below your entry point. But how much below? Where should it be? Let me bring the chart back on, and as you know, the different parts of position and where the stop loss is, where to put it. Some people, I can see in other videos, they say put it just right below this swing low. But if I put it here, before the market wanted to go up, it would have taken my stop loss here easily with this hammer candlestick. So I'm gonna, if you determine your support level correctly, you should know that you must put it somewhere below the support level. But where is that somewhere? Okay, that's gonna, I myself, I do prefer it below this shadow here. If the shadow is gonna be too long, one of those market making candles, okay, I'm not gonna do that, which I'm gonna make some examples later on. But in this case, it's gonna be here, and that's it. That's how I set the stop loss. If I wanted to enter the trade here, okay, again, I wanted to wait. Oh, I've seen this beautiful hammer here. And I had another divergence here. So it was the same level, but one harsh divergence in RSI. So another RSI, another divergence here, and it was a double bottom too. So I could enter the trade here after candle close above the EMA 20. It's going to be here. And again, stop loss going to be below here or here. And that's it. But how much this number of a stop loss should be, I'm going to talk about that later on within this video, but that's how to set that. Let's take a look at a short position here. So it's going to be just easy as a cake, easy peasy. So we had one high here, another high here. So it was a beautiful divergence here, higher high, but we had a higher low in the price in RSI. So we wait for a candle close. We had other indications too, 3 black crows. We had 1 shooting star, 2 shooting star, engulfing. but we wait for a strong candle close below the EMA 20. So it was here. So this is our entry level. And again, this is our entry level. In a short position, the stop loss must be above the entry level. So again, long trades like this, stop loss must be below entry. In short trades, the stop loss must be above entry. Of course, because you're predicting for the price to go down. So your stop loss is going to be above your entry. So if the market is not moving in your favor, it's going other way like this. Let's imagine the market wanted to go up. It would have taken your stop loss and you wouldn't lose a lot of money. There are lots of rules to do that, which I'm going to talk about that later on. Some people say it shouldn't exceed 1%, but it's not going to work out like that. I'm going to come up with a really good strategy for you in the end of this video, so don't go anywhere. Just stick with me. So this is the stop loss. There are two rules to set the stop loss. First, it must be beyond your static level. So this is your static resistance level. Here it was your static support level. So it must be beyond that, just right before that. And it must be just right after the latest swing high in the case of short trade, and just beyond the latest swing low in the case of a long trade. So this is the way that you're going to put your stop loss here. And that's all about it. In this case, you are going to save your money. If the market's going against you, you're going to save money. But lots of not well-educated traders, they are going to see, okay, the market goes against them, and they're going to move their stop loss just like this, put it away like that. And that's not good. That's really bad. Remember, always, in a money management session, which is going to be next episode, I'm going to talk about this a lot. But just to point that your green area, let's say profit area, must always be bigger than your red area, or let's say lose section. So what we do here is trying to increase our profits size and reduce the size of our losses. That's how the game works. And even if we're going to lose some trades, the next trade profit is going to be as much as going to be covering the previous lose, which makes it almost erased, and you can feel, okay, I had no losses at all. Which I'm going to talk about that a lot, which we call that winning ratio. It means the ratio of your winnings in a trading sequence or a trading period. But the examples that I'm making for you now is without any leverage. So we are not going to timing our stop loss or take profits at the moment, or where to put our take profit. I'm not talking about those at the moment. It's only about stop losses. Then another example here so 2 examples for long, 2 examples for short. Another beautiful divergence happened here. Higher high in the price, higher low in the RSI. Just a quick note here, just for instance, does divergences happen always? In lower time frames, most of the times they happen, but you shouldn't always wait for divergences. If you can see them, perfect, more strong signal. If you can't see them, you shouldn't always wait for them. You can just rely on candlestick patterns. You can rely on chart patterns. You can rely on your, for example, EMA indication. Even you can use MACD. That's the trading strategy which I'm going to come up in the upcoming sessions. But I've already talked about some of them in the previous sessions. So divergence here, I'm going to wait for one candle to close below a strong candle. It was a beautiful one here. So short trade here. Where to put the stop loss? Just latest string high was here. And this is my resistance level. I'm going to put it somewhere around here and go all the way down. Another profit. So here I will wait for the price. Do I take a trade here? No. This is the reason when I tell you, okay, as soon as you see a trade, you must see some indications. So it was a beautiful divergence here. Yeah, beautiful. Wow, beautiful. I want to enter a trade. It's going to be lots of profits here. But it's not going to work out like that. Even though it was a beautiful engulfing candle here, a bullish engulfing, but I told you previously, you must wait for the candle close, a strong candle close above the EMA 20. If you wanted to only trade with a divergence and candlestick pattern like this here, it would have taken your stop loss. Even though if you entered this trade which was wrong, you would have lost less than your profits. Let's take a look at here. If you would have just put your stop loss here, it was 1.70%, 73% of loss. But your profits before that was, look at the number here, 5.73% profit, 5.96 profit, so almost 6% profits, 12% profit, another almost 6% profit, and another almost 6% profit. So you can see this loss was almost nothing due to the profits you made in the market, even though it was a wrong trade and you shouldn't take it. Take profit is an order that you place to automatically exit a trade when the price of an asset reaches a certain level. But in this case, it's to lock in profits. When you set a take profit, you're essentially saying, if the market moves in my favor by X amount, I want to lock in my profits. Taking profit orders helps to secure profits on trades that have moved in your favor. They can also be set at a specific price level or a percentage of the trade size. Take profit orders can also be adjusted during the trade, but it is important to remember to not get too greedy and take profits when they are available. Now let's talk about the take profit. Where should we put this take profit? Where should it be? Exactly. The basic form is that, let me just remove everything from here, and then I'm going to bring them back up, make it a little bit more clear to your eyes. All right. I wanted to take a short trade here. So it was my short trade, as I said previously. It was a divergence in the RSI with the price. I waited for a candle close below the 20 EMA, stop loss here. Where to put my target point or target points? Later on in the session dedicated to money management, I'm gonna tell you and teach you how to play with the target points and how to set several target points in order to make trading strategy more efficient. But here, I wanted to teach you the most basic one. This is a simple price action like take profit. So if I'm gonna divide this area from the resistance level to support level to 4 parts, let me remove everything to 4 parts, like from here to here. And I'm gonna divide it to 4 parts like this. Okay, first 25%, then 50%, and 75%. The easiest way, which I can enter a trade and set a target point, is going to be somewhere around this last area. But where to put it, the best way is to make it in half and put your target point somewhere around here. So this last 25% and make it another half, and this is going to be your target point. Let's bring everything back. And as you can see, if we entered a short trade here, put our stop loss here, and set our target point here, it was beautifully hit by a shadow of this candle. And then when you're out of a trade, you are less stressful and you're ready for the next trade. Okay, next trade was here, candle close here. I'm going to enter the long trade here. Where to put the stop loss is going to be below this shadow here. And okay, this 25%, I'm going to find the half of it. It's going to be here, this one. Let me change the color to something like green. Okay, so this is going to be my target point. I'm going to put my target point here, and it beautifully hits my target point right at this moment. Then I'm out of this trade and I'm ready for the next trade. Okay, another divergence here, short trade here. You see how beautiful that is. Stop loss here, and target point was where? Yeah, I can see this. You see that 50% mark of this last 25%, and our target point is going to be here. This is what I call a beautiful stop loss and take profit and now you have it. That's how to set your stop loss and, of course, your target points. Leverage is a double-edged sword. It amplifies your gains, but also your losses. Leverage is essentially borrowing money from your broker or, let's say, exchange to trade a larger position than your account balance. It's important to use leverage wisely and never risk more than you can afford to lose. Leverage is a powerful tool that can increase your profits, but it can also magnify your losses. It is important to use leverage wisely and never risk more than you can afford to lose. Remember that. I'm repeating that too much because it is important, really. The amount of leverage you use depends on your risk tolerance, trading strategy, and market conditions. Generally, a leverage of 2x or 3x is considered to be a reasonable amount of most traders. But how to work with leverages? How to do that? In the beginning of your trading, as a beginner, as a rookie, if you've been into trading, okay, that you know what to do already. But if you're new to trading, what to do with leverages? What should you do? How much leverage you should use? In the beginning, I would say no leverage at all. Zero leverage for you as a beginner. But let's say you have practiced for a while, let's say for a month. You've practiced for another month. You've been market watching and doing paper trading. By paper trading or demo trading, it means that you're trading without any money, but now you are at the level which you want to trade with the real money. So of course the amount of money you're going to enter trading is going to be so low, like something like $100 or even less than that, but $100 is a good number. And then you want to enter a trade and you want to use leverages. So at first, for the first month of your trading with real money, use no leverage at all. But let's say you've passed this 3-month cycle and you want to enter a trade. As for the beginning, you must enter your trades with no leverage more than 2 or 3. Do not use that. And how to use leverages, later on, I'm gonna upload videos about trading platforms like exchanges. Later that for Forex trading via brokers and MetaTrader application, don't worry. But how the leverages work, it's really easy. Let's do the math above here. Let me write it down for you here. Okay, your volume is 100 USDT, all right? And this is 100 USDT volume. And you want to enter a trade. If you wanted to enter a trade here, let's analyze this one. Okay, your entry level was here. Your stop loss was 1.96%, and your target point was 5.38%. So let's do the math here. And in order to make everything more clear, I'm gonna make them fixed numbers like 20%, like 2%, and 5.5. If you want to set a certain number, you can just do it right here. So your stop loss would have taken 2% from you. So let's do the math here again. SL was equal to 2%, which means 2% of $100 is $2 USDT. And then your TP was at 5.5, right? 5.5, yeah, that's it. 5.5%, which means 5.5 USDT. That's it. So you're going to use leverage, right? If you want to use a leverage in this case, for example, let's say 10x leverage, but you're not allowed to do that. Later on, I'm going to tell you. For the beginning, 2-3x leverage is enough, but I'm using 10x to make it rounded up. So it means timing everything here in 10. So let me copy this one here. It means that I'm entering my trades with 100 USDT times 10. Why I'm not using $1,000? Because that's not real. It's like you're borrowing that money, but everything is going to be timed here. So your loss is going to be 20. And if you're going to lose, you're going to lose $20. And your tip is going to be 55%. And if you're going to win, you're going to win $55. What I want to tell you here is to keep in mind, it depends a lot on your trading strategy, on your, it takes a lot of experience to use 10x leverage. Even I myself, I'm not using 10x leverage all the time. And I'm not exceeding that, like say, in 99% of the times. If you see those kind of advertisements using 20x leverage, 50x leverage, that's crazy, you know, that's gambling. I do not believe in that, and I'm going to later on tell you why. But in this case, this is not for you. It's just an example. Please don't do it in the beginning, especially if you're a beginner. Use no leverages at all, but we're gonna have a 20% threshold. Let's put it here, and this is my rule of thumb. My losses when I'm using leverage, whenever it's gonna be, is not going to exceed 20% of my whole capital. But for you as a beginner, it shouldn't exceed more than 10% if you're a beginner. So whatever number you see here, okay, in this case, let's make it easier right now. In this case, it's 2% of loss. So in this case, you are allowed, after that 3 months of practicing using no leverages, which I told you before, in this case, you have 2% of loss. You can use 5x leverage because 2 5's time is 10. So your threshold of loss is 10x. So you can use 5x leverage. But if you win, you're gonna win 5.5 times 5, just like that. Next one, here. Your loss was at 2.55%. Let's say 2.6. In this case, you can only use leverage, amount of leverage, which is not going to exceed 10%. So let's say it's a 3%. Let's put it here, 3% loss. You cannot use any leverage more than 3x in this case. But if you win this trade, it's going to be like 5 times 3, like 15% of profit. Next one here, it was almost 2%, so you can only use 5x leverage, and your profit is going to be 5.38 times 5. This is the calculation, the risk management you should do. If you're confused or you think you don't know what is it all about, just feel free to ask me in the comments below. I try to do my best to explain it to you. And in the upcoming sessions, we're going to talk a lot more than this, and we're going to make tons of examples. Don't worry. But if you don't get it at all, just feel free to ask me. I would be happy to help you out, because I've seen lots of people, lots of traders are confused with these concepts. Where should we put our stop loss? How much leverage we should use? So here's a rule of thumb. Again, I'm going to write it down for you here. First months of your trading, after the training course is going to be finished, this training course or any other training course, first months is going to be dedicated for only market watch. Then second month is going to be only dedicated for demo trading. It means trading without money. Third month is going to be for your trading, actual trading with real money, but with no leverage. And then from fourth month to let's say 6 months, you're going to only choose in between no leverages to 3 leverage at maximum. So this is the rule of thumb which I wanted to tell you. This is what you should do if you want to become successful. I know that you've counted on this money, you came to, but believe me, there is no detour. There is no shortcut to become a millionaire in one night or 1 month or even in the first year of your trading. Go slowly, improve your skills. Then you realize that by time you are following up everything I've told you properly, you are making money, and you're making like crazy good money. And then after that, after 6 months of trading, you're allowed to choose, let's say from 6 months up to 12 months, you're allowed to use in between no leverage to 5x leverage. After a year, complete year of trading, gaining experience, and working on your issues, probably which I'm gonna be there, always there for you to help you out completely for free. Then in this case, after a year of trading, gaining experience, you're gonna realize that you can use more leverages, higher leverages. That's up to you. I myself, I said 99, but let's say 95% of the times I'm choosing at last 10x leverage, so my tolerance is in between no leverage up to 10x leverage. Sometimes I'm using, let's say, 15x leverage, and let's say 1% of the times in really low time frames, I'm gonna choose 20x leverage, which I'm not recommending to you or any other traders at all. That's crazy, and the risk is so high, and it can take lots of your profits, which you really worked hard for a couple of weeks, or let's say months or days, and that's gonna hurt, believe me. Managing risk is all about finding the right balance between potential profits and potential losses. But risk management doesn't end here. It is important to continually monitor and adjust your stop loss and take profit orders as the market conditions change. If the market moves in your favor and hits your take profit level, it's important to take the profit and not get greedy. Similarly, if the market moves against you, it's important to cut your losses and exit the trade according to your stop loss level. Reviewing your trades and performance is also an important part of risk management. By analyzing your trades and identifying your strengths and weaknesses, you can adjust your trading strategy and risk management techniques to optimize your performance and reduce potential losses. One effective tool for tracking and analyzing your trades is a trading journal, which I'm gonna teach you later on by the end of this course how to write one. A trading journal allows you to record your trades, track your performance, and identify patterns and trends. By reviewing your trading journal regularly, you can identify areas for improvement and refine your trading strategy. Risk management is a crucial skill for any trader. By using a stop loss, take profit, and leverage wisely and continually monitoring and adjusting your trades, you can optimize your profits and minimize your losses. Remember, trading is a marathon, not a sprint. Focus on long-term success by mastering risk management. So as you could see, it is really important to have a really good and reliable risk management system for different types of the market. If you have a proper one, you're gonna slowly grow your account, and after a short amount of time, before you're gonna realize, you're gonna grow your capital account significantly. I talk to people throughout the time, lots of people, especially with holders, let's say hodlers, and even traders, and I talk to them and I ask them, still ask for today, and I ask them, what is your risk management system? And they say, what? What is risk management? And when I ask them, do you set stop losses? And they say, what is a stop loss? And I am so surprised. And believe me, due to the rule and law of 91% losers in the market, the majority of those 91% of losers are people who are not even familiar with this kind of stuff and didn't even heard of it. So just practice. Feel free to ask me any questions popping into your mind. Watch my previous videos, and I promise you, if you follow up everything that I'm telling you, you're going to be a successful trader with good practice and proper risk management system. Risk management. This is not a subject that we only use in financial markets. This is a daily phrase that we always use. If I do something, is it safe? If I go to the road in my car, is it safe? If I fly and travel with an airplane, is it safe? So we ask this question from ourselves or the people around us during the day, directly or indirectly, like billions of times. But when something that we are dealing with is becoming already risky, we're trying to focus more on the fact how to avoid those risks by risk management, of course. And now let's talk about another really important aspect of risk management, which brings us to risk to reward and winning ratio. These are, of course, some of the key concepts that we as traders and investors must use in order to minimize our risks and maximize our profits. In this video, I will talk about what position sizing is, how we can use it, and how we can calculate it. And after that, I will also cover everything you need to know about risk to reward and the winning ratio, and how we can come up with a good balance in between them to make our trades more efficient and, in the end of the day, make some money. So let's get started. First, let's talk about position sizing. Position sizing is the process of determining how much of your capital to risk on any given trade. The goal of position sizing is to balance risk and reward to achieve the best possible outcome. Position sizing is important because it helps to manage risk. By sizing your positions appropriately, you can limit the amount of money you could lose on any given trade. This helps to protect your capital and prevent large drawdowns. To calculate position size, you need to consider several factors, including the size of your trading account, the risk you're willing to take, and the size of your stop loss. A quick stop here. So this is the reason I've told you in the beginning of the video, you have to watch my previous video, because in the previous session, I've talked completely about how to set our stop loss and where to put it exactly. Now with the upcoming knowledge and data that I'm giving you within this session, you can combine them all together and come up with your own strategy. The stop loss is the price level at which you'll exit the trade if it goes against you. The formula for calculating position size is as follows. Position size equals account size times risk per trade divided by stop loss distance. Let's say you have a trading account with $10,000 and you're willing to risk 1% of your account per trade. If you're buying a stock or crypto or any other asset with a stop loss of $1 below your entry price, the position size would be position size equals $10,000 times 1% divided by $1, which means $100. This means that you can buy $100 worth of the stock, crypto, or any other asset, and if the trade goes against you, you'll only lose $1. Don't worry about this kind of stuff. You don't have to calculate them all the time, because all the crypto exchanges and even brokers and MetaTrader application, there are tons of online calculators which you give them just the data that you want, the position size, whatever you want to give them, and they will come up with risk management and they will give you the data that you need. They're doing all the stuff for you. You can just give whatever you want to them and catch whatever you want in the end. But I'm only telling you this to be aware of the fact that you have to control these kind of things and you must be flexible. Later on, I will tell you why. Now, let's talk about risk-reward ratios. The risk-reward ratio is the ratio of potential profit to potential loss on a trade. This ratio is important because it helps you to evaluate the potential return of a trade and decide whether it's worth taking. A good risk-reward ratio is typically at least 1 to 2, which means that the potential reward is at least twice as much as the potential loss. Let's make an example to understand risk-to-reward ratio better. Let's think that I tell you, okay, I've prepared lunch for us and we don't have a drink. So it is so hot during the summer and it's in the midday and it's up to 30 degrees of Celsius out there. Okay, you have to walk 100 meters or let's say a kilometer to reach the supermarket and buy a drink and come back. And you think with yourself and say, that doesn't worth it. We can make a lemonade here, or we can just drink water and later on we can go out or we can just order a drink, a cold drink. But In the same time, same situation, I tell you, if you walk 10 kilometers in this weather with the same conditions, in the end of it, I will give you $1 million. Then you say, wow, that's really worth it. So, the evaluation and how much it's worth to do something means the risk to reward ratio. For example, let's make another example. If you're buying a stock or a crypto with a potential profit of $4 and the potential loss of $2, the risk reward ratio would be risk reward ratio equals potential profit divided by potential loss equals $4 divided by $2. It means 2 to 1 risk to reward ratio. A good risk to reward ratio helps you to increase your chances of success, because if you lose on some trades, you will still come out ahead if your winning trades have a higher reward than your losing trades. In order to understand that better, let's go to the chart and make some examples. Well, if you're new to the channel and you're new to trading and you don't know what is it all about, what is this chart, how does it work, I've made completely dedicated videos about this, which I'm going to leave the link both above here and down in the description. I highly recommend to watch those videos because it's a nonsense to you if you have no idea what I'm talking about. I'm going to talk about lots of things, support resistant areas or supply and demand zones. I'm going to talk about the indicators, divergences. So these are the things which I want to talk about. If you have any idea about those, it's going to be where you're just having a hard time understanding what I'm talking about. But if you're already into trading and you know what I'm talking about, so just that's for you. First, let's talk about risk to reward ratio. So I'm starting by determining my support and resistance areas, which I'm going to later on go to Bitcoin chart, a live trade, let's say almost a live trade, which I took 2 days ago. It hit my target points, and I'm going to talk about lots of things. But let's determine our areas here. I'm not changing the color of the areas like the previous sessions because you already know that which is the support, which is the resistance, and when a level is going to be lost, it's going to transform itself. So for example, in this case here, it was a resistance level, then it was breached, so it becomes a support level afterwards. Let me draw everything. In this case here, let me zoom in. This is Ethereum or ETH to USDT 5 minutes time frame chart. In this case, if I wanted to take a trade, so I look at the things which let me bring my EMA 20 period legs and my RSI, how to work with them, fully dedicated video previously, go check them out. But if I wanted to take a trade, so I had a beautiful divergence here, a big lower low, then I had, let me determine it for you again. So yeah, it was a beautiful divergence here. And I wait for the price, for some more indications for the price to go above the EMA 20. So it went here, and previously I had one bullish spinning top here. I have 3 white soldiers. So good indications. Here I could enter a trade, a long trade here, put my stop loss here. How to do that, I talked about that completely in the previous session, how to do this. So we're going to waste no more time. That's going to be what I was talking about. So in this case here, you can see, let me remove everything to make it more visible to your eyes. Yeah. In this case here, you can see this number here is 2. It means it's a 2 to 1 risk to reward ratio. If you take a look at here, these numbers, my profit would be 3.65% and my loss is going to be 1.83%. You might ask yourself, okay, my loss is more than 1%. What should I do? I talked about that previously in previous session with the data from that video and the data here with playing with our leverage and all those things. We can manage how to do that. But here and now, I want to talk about risk reward ratio. So it's fixed out on 2. But should it be always like this? Of course not. Lots of people, they say it must be at least 1 to 2. Less than 1 to 2 is not working out. But believe me, you must be flexible with the market. Otherwise, if you won't be flexible, the market is going to break you. Believe me. Later on in this video with other examples, I will tell you what I do as myself. I will talk about this later on a lot in my upcoming videos, but I will make an example just on Bitcoin chart, what I did like 2 days ago, and it just hit my targets like a couple of hours ago. As you can see, so it's the true definition. It means that the profit I will take from the market is going to be 2 times bigger than the loss that I'm risking for my on my trade. That's long story short. But I couldn't put my take profit here. Why? Because my resistance level was here, and due to knowledge that I had from previous session, I know that I must put my target point somewhere around here in this quarter here. So here's a rule of thumb. If your risk to reward ratio, keep it in mind for me. If you keep your risk to reward ratio somewhere in between, let's say 1.25 to 1 up to 2 to 1. That's good. In this case here is 1 to 1.25. But in this case, you have to keep in mind, which later on I'm going to talk about a session dedicated to money management. I will tell you how to manage your leverage within these trades like this. But and how we can hedge, what is hedging, and we will talk about those later on in the sessions dedicated to how to work with exchanges and how to take real orders and how to do these orders, because now we're talking about risk to reward ratio, where to put the stop loss, but how to do that, we must do this with real money on real accounts in exchanges, or in the case you want to trade stocks or commodities or even forex, you must do it in MetaTrader application. But here and now, I only want to talk about the risk to reward ratio. So somewhere, the least you can do is 1 to 1. But 1 to 1 doesn't worth it that much. Later on, you will realize it. For sometimes I do it, but I see it's a really good trade. But I do it for step-by-step taking profit, which I'm going to talk about that just in a moment, in the upcoming minutes. But somewhere in between, I prefer somewhere in between 1 to 25, 1.25 to 2, something like that. But how do I do it? I'm making an example on long positions. You can do it on short for yourself. If you have any questions, you can just ask me. Let's go to Bitcoin charts, and what I did was like this 2 days ago. Let's bring everything up. So I drew my Fibonacci levels, and by Fibonacci levels, I set my target points. These are my support and resistance areas, my Fibonacci levels. I talked about those. Check the links down below. I'm going to leave a link above here too. Then here in the market, I decided to take a long trade. Here, exactly here, my leverage was 10 and my stop loss was below this shadow. So my first target point was here. So you can see it's more than, it was here. It was exactly at 1.25. So what I did was let's say I've entered a trade with $100. So my first target point was here, and I came out of the trade like 50% of it. So as you can see here, it was 1.81, let's say 1.8% of profit. So with the leverage of 10, it was like 18% of profit. 18% of $100 is $18, but I got out of the trade with 50%, so which makes it $9. So let's put it here. And it was with 10x 9 USDT. Then what you should do here, you must save, we call it the trailing our stop loss. You must remove your stop loss from here and put it here on your entry level. So when the market, so it hit my target point here. If the market turns back against you, so you will come out of the trade with the other 50% without any loss. We call this making your trades risk-free. Then I had another target point, which was here in this area. So I took out of a trade here. So let's say I didn't take another trade. I was in the same trade, but so I have no loss here because I made my trade risk-free. So I am in no risk at all now. If the market goes down against me, I will lose no money, although I made even $9, 9 USDT. So it was another trade I've entered here. So my trade is now risk-free. If the market goes down by reason or whatever it is, I won't lose any money, although I made 9 USDT too. So here, what I did is I'm continuing with another 50% of my trade, and I set an order for 25% here. You can do the calculations for yourself. Each time the price is going to hit my new target point, I will take my stop loss on the previous entry. Let's make an example, not to make you confused. So my first target point was here. When price hit my first target point, I remove my let's say I move my stop loss from here to my entry level. Then the market goes up and hit my next target point. So I take my stop loss and put it on my target point. And then the price hits my next target point and I remove, and just like that. So I got out of the trade 50% here, 25% here, and another 25% here. And I made a really good deal out of this trade. I'm doing the math for you. So I had $100 and my first target point was here, 50%. Okay, minus 50%, it equals to $50, of course. So $50 had a profit of 1.74. So it times 10 because it was a 10x leverage. It means 15.4 plus percent, 58.7. Let's write it down. It was not accurate. It's almost 9. 58.7. And then I remove it. I have another $50. How much profit was the rest of the trade? It was like from here. So I had, don't mind this risk because we entered the trade here and now our stop loss is at this point. So don't mind this. Let me change the color not to make you confused. Okay, so from here to here was another 2.828%. So I just bring up the calculator. I've got $50 left, but I've got out of the trade here with 20%. 25 means the half time of it. So it was $25. $25 plus 28% profit. It was a 10x leverage, so it was like 32. I have here 32. And then I have another $25 here, which I go all the way up, and I move my stop loss from here to here, and then I come all the way up here. It was another 20%. Yeah, so $25 left, $25 plus 20%, $30. Let's now make the do the math here, and it's so easy. 58.7 plus 32 plus 30, $120. How much I had in the beginning? $100. I made $20.7, let's say almost $21 in this trade, and it is amazing. So if you want to calculate how much percentage I made, so it was 117.5 almost percent here, 128% here, and 120% here. But it was not all on $100 because I came out of the trade each place I had a target point. So this is so-called risk management, of course, beginning of the subject which I want to talk a lot about in the upcoming sessions, the money management. And by this technique, you can just make your trades risk-free. So to sum it up, let's make an example. Let me just delete everything. Let's go to another chart. Let's go to, imagine we have two people and they want to make like 8 trades. The first person is Mike, and he has, and both of them, let's say Mike and David, they both have $1,000 or let's say USDT, and they want to trade with the risk to reward ratio of 2 to 1. All right. So it means that their wins are going to be like 2 times bigger than their loss. But Mike is going to risk 250 USDT in each trade. David is going to risk $30 or USDT per trade. What happens? Let's imagine first 4 trades are going to be losses. So Mike is going to be like 1,000 minus 250 first trade, another 250 next trade, another 250 third trade, and another 250 fourth trade. He will not even reach the other trades, the other 4 trades, and he becomes zero or wiped out at this point. But in the case of David, we have with the same criteria, same thing, same story. So $1,000, he will going to lose $30 in the first trade, another $30 in the next trade, another $30 in the next trade, and another $30 in the next trade. His money is going to be how much? $120 are going to be out of his account, so $880. Then he will make money like his wins are going to be 2 times bigger than this, so $60 on each trade. This is, so it's going to be plus 60 plus 60 plus 60 plus 60, and it becomes, so it's $240, which makes it $1,120, or let's say USDT. So the first trader, without proper risk management, who was Mike, he wiped out his account in the first 4 trades with the same criteria and same trades. First 4 trades going to be losses. So David lost like $120, then he made $240, and now he is $120 more than his capital account, which was 1,000 USDT. So this is a long story short. Finally, let's talk about winning ratio. The winning ratio is the percentage of trades that are profitable out of all the trades you take. A good winning ratio is typically around 50% or higher. The winning ratio is important because it helps you to evaluate the success of your trading strategy. If your winning ratio is high, it means that your strategy is effective and you're making money. If your winning ratio is low, it means that you need to adjust your strategy or risk management, which most of the time is all about your risk management. Because if you even choose the shittiest, the most crappy trading strategy, in the end of the day, with a good risk management system, you can make money after a while. A while here, which you can evaluate your and give some weight to your winning ratio, is mostly each 100 trades period. So if you're trading on lower time frames, you can evaluate that, or let's say you're scalping. You can evaluate that sooner. If you're trading on higher time frames like daily, weekly, that may take up to weeks, months, or even years. So first, we must come up with the fact that in which time frame we want to trade in, and then after each 100 trade, evaluate our winning ratio. And for example, say out of 100 trades, how much of them were wins, how much of them were losses, how much losses I had right after each other, and how much winnings I had right after each other. Then we can come up with, this is the reason I'm telling you, you have, all the things that I'm telling you, it's not something I inject into your veins. It's all about, on the other side of the coin, it's all about the experience. You must experience it for yourself. Even if you market watch or do demo trading, it's not just like the real world. Let's make an example for you. I can remember back at my university when I was trying to become a pilot, and we had these simulators, and they were really good to reduce the cost of lots of teaching stuff instead of just flying with a real helicopter, just going to the simulator and do it for yourself. But in this case, you had a lot of time to learn lots of things instead of flying and burning lots of fuel and putting ourselves in danger. But there are things that you cannot feel properly while you are within a simulator, like the real world feeling of having a sudden descent up in the air. So here in the market, it's the same. You can practice, and learn a lot of things, like thousands, millions of things while you are paper trading or demo trading or market watching. But when you bring your real money in the market, as soon as the money is getting bigger and bigger, the challenge is becoming harder and harder. Believe me, and that psychology part of the market, that risk management becomes more bold and it becomes more important. That's the reason I'm telling you that this is not all about theoretical things in which I'm telling you. You have to focus and practice and gain a lot of experience. So there you have it. You see how important it is? You have to mix everything I've told you about this session plus previous session, come up with your own plan. So long story short, imagine how much drinking water is important to human body safety and health. So I could say water is equal to technical and fundamental analysis, but how much important risk management and risk management techniques are. It's like the oxygen to you. So see how much important that is? Let's waste no more time and dive right into it. I'm here to tell you different techniques for risk management. Besides the techniques I've told you on the screen, and that was the doing part of the job. So this is the thinking part of the job. So don't go anywhere. Fasten your seatbelts. Sit tight. We're gonna have a lot to discover. First, let's talk about risk identification. The name is amplifying the meaning of it. It means that to identify the risk. What the risk really is. Let's put it this way. There are two types of risks. One is internal, second is external. What is internal? It means inside the system. It is related exactly and directly to your technical analysis. If you don't identify the risk, it means that you didn't understand the right position, you didn't get a right trade, or you didn't buy an asset in the right time in terms of investing, or if you want to hodl something, or say let's hold something. It means that you didn't. Let's make an example. I talked about this previously a lot, and we talked about everything. There's nothing left and nothing untold. But let's make an example here. If you cannot determine support and resistance, or let's say supply and demand zones correctly, and then you're gonna enter a trade in between two ranges, trading range. You're gonna enter it in between two ranges, and then the market tends to go up, and you realize it correctly that the market wants to go up. But before going up, it has, as we know, the market is not always going in a line. It goes up and down. It's like waves. And then in this up and down, in this higher highs, higher lows, in some places it's gonna take your stop loss and then go up, and it will hit your target. But you're gonna keep thinking with yourself, what did I do wrong, and why it went and hit my target, but I couldn't take the trade correctly? It is because you didn't identify the risk correctly, and you didn't identify the situation correctly. Second, it's all about the external factors which can increase the rate of the risk. For example, like news, like a pandemic coming to the world, like COVID-19, like war, lots of things. You can check all of those. Previously, I made a video which I'm gonna leave a link about here and down in the description about fundamental analysis basics and the crucial websites to check the news and everything about cryptocurrency. And you must always, before starting your trading day, check those news and keep yourself updated in order to identify the external factors. For example, if you hear that each month there's going to be a meeting in United States of America, and they're going to decide that they want to increase the interest rates or not, so that can affect the market. But you should not trade with it, as I've told you previously. You should not trade with it. You have to make decisions based on both fundamental and technical analysis. That's in the end of the day, it means identifying the risks both with internal and external factors. Second risk management technique is risk assessment. Once you pass the first stage and you could identify the risks, now you have to assess them. How to do that? You must encounter, okay, so if I want to take this trade, or if I want to buy this asset or sell this asset, whatever you want to do, what are the consequences? if I take this trade or I do this investing, the risk is going to happen eventually, and it's going to hit my stop loss, or I'm going to lose that money. What are the consequences? What are the impacts? Well, how I'm going to deal with it? Can I tolerate it or not? Because if I can't, let's imagine I invest $1,000 in a trade and I want to enter a trade, a long trade, and I can tolerate losing $100. That's the amount of money I can tolerate to lose. So that means assessing our risk. Third step is risk mitigation. After two first steps, now we can measure the likelihood of those losses that can occur during our career or in that particular investment or trade. Let's make an example. For example, you want to buy and hold, or let's say hodl. The reason I'm always saying this or that, hold or hodl, is that because you know the meaning of hold. But in the financial market, we say hodl. We shouldn't risk on a dead horse. Isn't it true? Of course it's true. Because a dead horse cannot even walk. Imagine it wants to race. So in this particular example, if you want to buy or do an investment on a particular token or coin, or let's say altcoin or even Bitcoin, you must check the historical data. You must check the news. Or even if you want to take a trade, when the market is with high volatility, especially in the beginning of your career as a trader, you should not take trades. It's like the sea. You know, when the sea is going crazy and there is a hurricane going on, everything is not okay. You cannot see it through the water, but when the sea is calm, the water is crystal clear. It's beautiful, it's calm. You can go tan your skin on the beach, and you can just chill out, right? So chill out when the market is calm. And avoid trading in high volatile market or even a really low volatile market, because that's dangerous too. Why? Imagine on the weekends, although the cryptocurrency market, unlike the stocks market, FOREX market, and the other markets, is 24/7. But I myself and lots of traders out there, we do not trade on the weekends. Why? Because there is so much of low volume going on in the market, and market makers can come in the market and with a really tiny amount of money, or let's say asset, they can just, of course the name implements, making the market. And for example, you want to take a long trade, and of course, as you can determine the support levels, the others can do too, especially the ones who are willpower within this market, like the cryptocurrency exchanges, like the whales. Whales, here's open a bracket. It means an individual or an organization possessing a vast amount, big amount of a particular asset, or let's say assets. And we call them whales, because if they bring it to the market and they sell it off, or they buy a high amount of it, they can change the direction of the market, or let's help it to help the market to change direction. So to sum it up, we shouldn't trade, especially in the beginning of career as a trader. We shouldn't trade in the really high volatile or low volatile market. We shouldn't invest or buy an asset when the world is going crazy. For example, there is a war going on in between Russia and Ukraine, or there is a pandemic like COVID-19 going on in the world. So you have to wait for the sea, for the hurricane to calm down, and wait for the clear blue skies. Next is risk monitoring and review. After past three steps, now it's time to review and step-by-step follow up our trade, or let's say investment. In the previous episode, I talked about completely how to remove and trail our stop loss, and how to come out of trades step by step, and let's say make our trades risk-free. It is exactly about that. So do not become greedy. You cannot, there is no one, believe me, no one in the world who can determine and understand the exact point of the market turn points, or let's say market reversals. So no one knew that the market will like let's say Bitcoin market, like the Bitcoin price will just drop off from 69 something dollars, or maybe it was 68. You can determine areas, as I told you before, to determine support and resistance, let's say supply and demand zones. That's why we don't determine them with lines. That's the reason we determine them and mark them with areas. It means that we are guessing an area in between A to B, or from B to C to be the area of our prediction, but we cannot understand the exact point. So in this case, we shouldn't become greedy. If we want to invest and we want to, for example, buy, let's say, Bitcoin at the price of 15K, we wait for it to reach 200K. It may take a decade or maybe 2 years. It may even happen in a month. Who knows? But when the market is, you must have a plan, which I talked previously a lot about it, and I will talk about it a lot in the future. But keep it in mind right here, right now. You must have plans for yourself. Plan A, B, C, all the way to Z. It means if you enter the market at point A, you must have an exit plan on point B, then another exit plan on point C, then another exit plan. So you must divide it, divide your profits, and bring your money out of the market, because it's a risky market. If you want to say, oh, it's good, let it go up, let it go up, let it go up, let it go up, but then you find yourself that you didn't even grow your money and you've lost some of it, or let's say all of it, and made yourself call margin. So now that brings us to number 5 technique in risk management: scenario planning. I talked about the fact how to do things, how to determine the risk, how to measure it, blah, 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 blah. But how to plan the scenario? Let's make an example. You've made a prediction and you made a trade for a long trade. And you see that the market is going up, and it's going up really good, really well. But at a certain point, for example, from A to C, and at the B and the point B, in the middle of the way, or let's say the third of the way, somewhere in between, you see that the market cannot go up, and you see indications, lots of indications that the market is about to reverse. You shouldn't insist on your previous analysis. Or, for example, you're making your trades and you're going long, or let's say you're going short and everything is going crazy beautiful and you're making good money, but you see, for example, something happens in the world. There is a war going on, and you see some sudden movements in the market. You must be aware and you must be cautious. And how to do that? Of course, I've told you before in technical analysis. Check my previous videos, episodes, and seasons. Last but not least is risk communication. In order to do this, you have to be in the community. How to do that? You can use Twitter, Facebook. There are tons of, you can even use the TradingView platform, or CoinMarketCap website, which I talked about those a lot previously. I don't want to dive into that right now, but you must be aware of things. For example, if you want to cut up yourself from all the news out there, because I've heard lots of people that say, we only trade with fundamentals, we only trade with technicals, we don't want to trade with fundamentals, but you have to trade with both of them. It is not up to you to say, okay, I don't, it's like, okay, I only want to brake my car with handbrake. I don't want to use pedal beneath my foot. Or there are like thousands of examples like that out there. But you have to use a combination of those. So fundamental analysis here. You go to the community and you hear that, for example, some asset like Ripple, gold. The oil price is going down. The oil price is going up. There is a war going up in the world. I can imagine there was this hearing on XRP Ripple project, and Ripple won that case in the court of law. And I can remember, still I haven't seen anything like that. It was last year, I think. I haven't seen anything like that going crazy in short time frame like that. It was, you know, the Ripple was going to the moon. And I couldn't even see what is going on. You know, the candles were going out of my screen. It was crazy. So you must be aware of these things, especially about if you want to be successful, especially about the things that you are used to trade on daily basis, or you have invested before, or you are about to invest. For example, let's make another example. If you want to invest on Bitcoin, if you want to invest on altcoins, you must know that what is happening to Bitcoin, because they are all alternative to Bitcoin. And most of the time, let's say more than 90%, 95% of the times, they are falling off the price of the Bitcoin. So you must have a good analysis and information about Bitcoin, and then do your... So let's put it this way. If you want to invest or trade on altcoins, your job is going to be twice harder, because first you have to do all of them on Bitcoin, then bring them all to the altcoins. Because if something happens to the Bitcoin, it is going to be more or less happen to the altcoins too. So did you like this content too? If you really like it, please hit the like button, share my videos with your friends who are keen to learn all about this messy world of trading, especially cryptocurrency, which is on fire nowadays. If you haven't subscribed to my channel yet, do it right away. And if you don't have any questions at all, just help me out to make you become better, and even help myself become better and making better contents for you. Thank you for watching.